The next session is, around a newly listed public company. I would like to invite Mr. Suhas Prabhu, who is the Chief Financial Officer at Indegene, to navigate us Indegene's journey from being a startup to an unlisted company, and then finally ringing the bell, and how ESOPs have worked in this scenario.
Very good afternoon to everyone. Let me actually start by thanking Capita ESOP Direct and team, as well as the audience, the participants here who have been actively interacting at this forum, because I believe that is the strength and the need of the hour. And a lot of things that I would probably talk about today is something that I see has been addressed in some shape, form, and manner by participants in this forum. Right, those were issues, challenges for us at some point in time, and today there is an attempt to solve that. There's an approach to evolve and move ahead, and that's the power of forums like this. And therefore, really commend all your participation and the team at Capita to create and sustain this forum. With that, let me probably, the way I would go about today is to probably give a bit of a context, more to get people to relate to things in a manner that would apply to you yourself, and then share the experiences, the challenges, and the evolution that we have gone through. So, as it was mentioned, I am CFO at Indegene. We listed in May of this year. Company has been in existence for around 26 years. We listed around the time of our 25th anniversary. We are a digital first commercialization partner to the global life science industry. But let me not get into what we do as a business. What would be more relevant is that today we are a 5,000 people organization. 750 of us are actually based outside of India. What we do is very specialized, which means that a lot of people that we have are highly qualified professionals. 23%, 22.5% of people at Indegene are actually coming from a medical and life sciences background, which would mean that these are doctors, PhDs, or postgraduates in chemistry, biosciences, and the like. And we have offices globally, right? We operate out of 18 offices, 11 to 12 countries, and that's relevant because we are present in all the key markets for our customers, right? These are the innovator pharma and med devices companies, right? And most of the market from a value perspective is US, Europe, China, Japan, right? And that's why our footprint is what it is. As you can see on the map here. Another interesting fact, almost 45% of our employees are women employees, and has been consistently so for, I don't know, forever, I would say. So these are some of the demographics. Let me get into the evolution of the stock compensation plan at Indegene. I would say while we were registered as a business in 98, we started business actually in 2000, and what is today called as Series A, B funding, that journey actually started even later. These were days when the funding scenario was not what it is today. So I would say 2005 was when Series A happened, and therefore whatever is relevant from a stock plan is post that period. And 2005 was when actually we got a lot of learning experience, because the investor that we got on board in 2005 was the family office of N.S. Raghavan, one of the co-founders of Infosys. He was actually managing HR till he retired from Infi. Experience and knowledge was something that came. He was our chairman of the board for a very long time, I think 2007 through till 12 or so. With that, came the first plan, which was a plain vanilla ESOP 2007, right? Not a broad-based plan. We even today don't have a broad-based plan, right? The intent at that point was long-term value creation, right? We participated in this both in India and outside India, and at that point, I would say largely US was where we had presence outside India. It was not an RSU plan, right? It was there was an exercise price which was a discount to the fair value. NSR was actually very insistent on that because it's participation in value creation rather than dole out that was being given. At the next stage, 2015, we moved from a ESOP plan to a RSU plan. This came at a stage of growth of the company where we were actually hiring a lot of people outside India. We'd also done a bunch of acquisitions, and therefore we had a lot of entrepreneurs who had created their own small companies outside India to be now part of Indegene. What you're acquiring in a business like this is eventually, the people asset, right? That's what is there, and therefore it was key to retain that talent, right? Including people who are entrepreneurs themselves and have proven themselves by creating those companies that Indegene acquired over a period. We did about 11 acquisitions between 2012 to 2019, and the ESOP 2015 plan was designed with not just the earlier intention of long-term value creation, sharing of that, but also retention. And 2020, was the next evolution of this plan, wherein we introduced both ESOP and RSU plan, right? And this is what we have currently. This was done at the annual of the next phase of our journey. We decided, we'd done funding Series A, B back in 2005 through 2008, and no funding after that. We've been self-sustaining, even acquiring from own resources, so didn't have the need to go out and do fundraising. Has its positives from a financial perspective. I'll talk about some of the negatives of that. But this was before we decided to further externalize, just before we went ahead and got an external investor on board, going beyond the family office, got private equity towards the end of 2020, early 2021 was when we put together the current plan, which is with certain amendments still in currency, right? And just from a size perspective, just plotted this because that would also be somewhat relevant, right? About 200 people to the next evolution when we were about 5 times that size to 2 times that size in 2020. We are about 2.5 times that size today at 5,000 people, and the current plan that we put in place in 2020 is still relevant. Some features of the plan, and it has evolved through the period. There are not too many criterias in that 2007, 2015 plan, but the 2020 plan, the evolution was that at the time of grant, what is considered is not just the past performance, but the future potential and criticality, right? And objective scoring system on this, gets you to be eligible for the quantum of stock, right? Um, the quantum of stock, which we call as a supernormal portion going beyond the normal, which applies to, say, 70% of the people that are even eligible from crossing the bare minimum threshold, is something that we have differentiated in terms of not just the quantum, but also in terms of vesting, right? Instead of a normal 3-year vesting, for that additional quantum, it's a 4-year vesting, and it's a back-ended vesting and not a uniform vesting. It's designed to create value and share value over a longer period, and from a company perspective is also a retention tool, because you're going beyond the normal from a quantum of grant perspective. So we've kind of separated, using a differential vesting within the same plan. The size of the pool over period has expanded. Consistently under all these policies has been in the vicinity of 5%. Even now, it's in the vicinity of 4 to 5%. And the coverage itself today is a little north of 250 people, which is, I would say, 5% of the employees. So I would say leadership and senior management. The founders don't participate. So outside of the founders, everybody else in the senior management and above participates. From an overseas perspective, I would say not by design, but by nature of seniority, that ratio is actually more than 10%, a little north of 10%. More specialized and more, I would say, senior people, right, would, by nature of what we do, reside in markets where our customers are, which is the other offices outside of India, and therefore I would say coverage is about 10% for outside India and a little south of 5% for people in India, right? So this is the broad features. Now with that, let me move to the journey itself, right? Some of the things that we went through as a private company, then when we went ahead and externalized through a private equity, and then finally the listing itself. So as a private company, what we succeeded in was creating very high levels of ownership, right, coming from the Infosys example that Sparna spoke earlier, right, creating dollar millionaires of people who are employees and not necessarily the founders of the company. That was created, but the moment we went a little beyond that, we saw that the impact was not significant, right? Retention levels of people who were given grants versus those who were not, right? At this stage of the company, I'm talking the 2007 era, right? No liquidity, right? People who don't understand this, despite, I'm sure we could have done a lot better from a communication standpoint, but despite that, I would say very tough journey to use it as a retention tool. Even in the M&A journey, especially the ESOPs created very little impact. RSU was a slightly better instrument than ESOP when it came to retention of talent that we acquired through our M&A process, right? The 11 odd companies that we got on board. But what worked was doing it selectively. Senior people who have lived this journey, who realize through their own experiences, direct or indirect, where they have realized value, or somebody very close to them has realized value over period, right? Laterals, very few got attracted, especially given that there was no third-party validation of value and no liquidity, right? So those two challenges meant that had a limited impact. Overseas was even higher challenge, given that if the plan is not compliant with the 409A in US, ESOP in UK, and the equivalent in whichever jurisdiction, potentially tax liabilities can kick in even at the time of grant or vesting. There could be higher taxes, right? US, you have the excise tax, which adds a 20% incremental tax to the normal tax rate. So stocks are then lesser preferred than even cash comp, right? Because there's an incremental tax. Those were challenges. We tried various options of creating liquidity through employee trust structures, right? Even scouting for some potential buyers outside, but we are still private and not talking about the journey once you become public but not listed. Right? We tried even getting certifications from even the big four and stuff like that to establish fair value, but there's always that apprehension of whether that is the right value, right, at which I'm selling, and therefore I would say that that was not very effective. It may not be the case for private businesses which are doing funding rounds, establishing this value every few months to a year or two. You know, you're doing Series A to J, K nowadays before you go and list. For us, it was just A and B, and then straight jump to a pre-IPO funding, and then IPO within 2.5 years of the private equity round. So, so in that situation, I would say this was a challenge. Post externalizing, getting a couple of private equity on board, you know, in early part of 2021 when the closing happened, employees were provided liquidity for part of the vested options, right? And practically everybody opted for that. So there was an external buyer, there was a value, right, that existing investors were offering shares. There was you know, new issuance of shares, both primary, secondary, happening at that value. There's a lot more acceptance for liquidity at that point in time. Post that, there were other, you know, players, right? Some of the names that were provided by Vishnu, you know, who were actively involved, were buying not just from us, but also from the private equity for whatever their requirements were. And therefore, we could do 2 more rounds in 2 more years of a limited liquidity for employees on a need basis, right? But this was value at which many others would also offer, including potentially what would be perceived as savvy financial investors in the company, right, who were also selling at a particular value, and employees participated in that, right. Of course, through this period, attractiveness increased. People were wanting to be part of this journey. The pool increased as we grew. The number of people that got covered increased. And finally, you know, as we went public, we had to go through the exercise of ensuring that the plan is compliant with the SEBI regulations. Being private, you know, that would not apply. We are largely compliant, but then the regulations are also something that keep evolving, right? You make it more current. One of the learnings there was we were initially trying to see if the plan can encompass for multiple jurisdiction requirements into one plan. But what we realized that we were trying to stretch it a little too far. We started creating country by country sub plans, right? So we have a sub plan under the same plan for, we were able to do that under the same plan for US, but UK and, you know, eventually other countries, you know, maybe a learning if we had that earlier, even US, we would have done it as a sub plan. For example, there are restrictions on exercise period in the US. India, you can give a longer exercise window. In our plan, because we wanted to harmonize it for both US and India, we have a shorter exercise window, which is to the disadvantage of Indian employees versus, if we had created it as a sub-plan, you could have at least given a longer window for the people in India and so on, right? Those kind of nuances, right? We had to go through a amendment and ratification of the plan pre-IPO through a members meeting, but even post listing, immediately post listing, the same plan, no changes, got a ratification from the members post listing as well. And this was a period where we got to interact with the new stakeholders in the company and a new constituent proxy advisory firms, right, who went through the details of our plans, came up with vote for or not, recommendation to the investor community at large. We realized that that is another constituent other than the investors directly that you have to manage. One of the early learnings there was ESOP plans being with the exercise price being the market value or a small discount to the market value is fairly acceptable. Pool of 4 to 5% is fairly acceptable. RSU plans was a bit of a difference. I think the proxy advisory firms like performance-based RSUs than a time-based. Now, our variant, as I mentioned, the larger portion was actually based on performance, but at the time of grant and not at the time of vesting. Once it's granted, then it's a simple time vesting, right? We still trying to figure out and evolve the plan to become a performance-based vesting and not just a evaluation at the time of the grant. So that was a learning that we went through. Where are we today? Right, what we are trying to do today is, now that we are listed, there's a value attribution, right? People can realize, many employees today are holding on to options which were granted back in 2007. Different plans have, in certain cases, lock-ins and all of that. We have more than 6 months, all of those are behind us. So the intent or the focus right now is to make it as seamless as possible. I would say it is so for resident employees, right? So Indian employees for a Indian listed company, it's as easy as it can get. Of course, again, Vishnu mentioned what you have to be cognizant about is the insider trading and the trading windows and the like. Constant awareness, touch points to ensure that you don't slip on this, right? It's not just the employee, right? It's also a not great thing for the company from a brand and any other perception perspective when it comes to any slippages here. So from a resident perspective, I would say that is top of mind. Not saying that we are not doing that for the non-residents, but by design, given the hurdles that are there for non-residents to operate in the Indian market, right? By even without it being because of insider trading restrictions, right? The ability for non-residents to trade is so low that the risk is itself pretty much negated. Whereas residents today, with everything being available on the click of button on your mobiles, right? Even a small mishap can have a lot more implication. The other thing which I think the Shantanu Way to Wealth mentioned, cashless options to make it more seamless. We have the ability to do that for residents. Of course, you can include the NRI, NRE, right, even if they are based outside India. But challenges remain for non-residents. Still a lot of paperwork when it comes to just getting people to apply for a PAN and a demat account for non-residents in India, huge overhead, still a lot of challenge, both to convince the employees as well as get it done, even if the employees are convinced about going ahead with this. The cashless options are, from a NBFC or even a bank in India cannot be extended to non-residents. That is the other challenge. Tax, a lot of cases, the value on which the perquisite tax, and therefore the perquisite value that the employee bears outside India, there is a gray area on deductibility of that upon liquidation, right? So you would get potentially taxed capital gains on the exercise price minus the sales price minus the exercise price, and not the perquisite value, right? So there's that delta on which there would potentially be a double tax for the employee outside India. So those are some of the things which still make it not as attractive and not as seamless for non-residents. Is a disadvantage for a global company which is Indian headquartered, which is what we are, right? Because you need to be competitive in attracting this kind of talent overseas. They would obviously prefer an instrument which is traded locally, is issued by a non-India domiciled company, right? And if we have to be competitive, right, these are things that need to solve for, and hopefully, making this aware in these kind of forums and so on will help over period overcome these, even the regulators and whatever systems need to be aware of this and try to solve for it. Hopefully there will be action in the future. Finally, what are we also getting to overcome this partially is working with Jalaj and team on creating an employee trust, right? Going through the trust to overcome some of these administrative hurdles, especially keeping the non-resident employees in mind, and also as part of that, we intend to apply to RBI for cashless options for the non-residents, right? So that some of these challenges that they come across, end of the day, making it more seamless, making them realize the benefits, right? And so it's not just enough if you give them options, but help them, realize the benefits of this option. So that is the journey that we are on, and that has been the evolution. So those were what I wanted to share. If there are any questions, queries, let me.
Hi, I'm Mittal from Zeta. Thank you for sharing your experience with us. Just one quick question. What were your considerations in terms of where did you want to list the company? With now being a multi-headquartered kind of generation where your original headquarter doesn't matter anymore, I also realized through your slides of your footprint that you had great presence in US. So what were your considerations really to list with SEBI and not with to list in Indian exchange versus any other exchange globally?
Yeah, frankly, if you want to keep it compliant with the regulations in India once you're domiciled in India, right? Unless you want to do crazy and creative structures like SPAC and the like, you don't have an option. So let me say that that it's very difficult for a Indian domiciled or headquartered company to list outside India without a primary listing in India. We're not saying that we are not ambitious to not list outside India. That might be something that happens in due course, right? But this is, I would say, a step towards realizing that. What it does provide, of course, from a timing perspective, and that nobody can take credit for. Today, Indian markets are giving valuation as good, if not better, as many of the overseas markets. So that consideration, I would say, goes out of the window. Pretty much all the marquee investors in public markets in the US today invest in India, right? So I would say even for the mid-market segment, we are about, give or take a little, $2 billion in market cap today. And I would say, whatever my knowledge, 70-80% of investors in the US have offices in India or Singapore or Hong Kong with an ability fund dedicated to India or emerging markets. So I would say the investor community and valuation question is out. Brand awareness from a customer perspective, I don't think that we got that through a India listing, right? My customers are the likes of Pfizer, Novartis, GSK, who are headquartered in Basel or US, right? And listing in India would not give that brand visibility there. But from an employee perspective, almost 80% of my employees are in India. Attractiveness from a brand perspective is there. Liquidity for people who have been with the company over these 20 odd years is there. Exit for investors, right? Right from the family office, which has been with us for now close to 20 years, and the private equity is only 3.5 years, right? All of that would be the other considerations. And what we would lack, I would say, is listing in the US would have given more visibility from a customer visibility perspective. I would say even quality of listing requirements, disclosures, India is rated very high today, right? May not be as much 20 years ago, but today, I don't think anybody questions that. And that is seen because of the number of participants from US or wherever else in the world directly in the Indian market. So access to capital, which is otherwise available in the US or elsewhere, is no longer a challenge in India. Okay. Thank you for a patient hearing, and all the best.